What's up, guys? We're going to do another Wise Wealth video, and we've covered basically everything, all the most important things of the categories of investing. So following that, I'm going to do mistakes to avoid and things that might help you improve your investment strategies. This is not financial advice. I'm just going to point out very common mistakes. So investment mistakes and tips. The first thing is risking too much money. Now, obviously, you're going to say, well, who's stupid enough to risk that much money? There's a lot of people that risk money that they can't afford to lose, or they don't factor in how much they could lose. It's very important to calculate your risk. So what I would suggest is delegate however much money you're willing to lose and put it into either cash, a separate account, a brokerage account, but separate the money where you're willing to lose from the money that you don't want to lose. And understand that whatever money you're going to put into trading or investing has the potential to go to zero. It's not guaranteed that you're going to make money. Whatever money you put in, you can lose all of that money. Second thing is the risk to reward ratio. Now, I would suggest having a concise risk to reward or a high win rate. For example, you don't want to be risking $10 to win $1. That would be pretty stupid, right? Well, it depends. If your win rate is 95%, then winning $1 95 out of 100 times is going to, it might be better because you lose once, you lose $10, but you win 50 times and you win $50. You know what I'm saying? So a high win rate may mean risking more money, but high probability of winning. For example, selling options. Those are considered more risky because when you sell a call, it has an unlimited downside potential because if you get assigned the stock technically could go to zero, but let's be realistic. If you pick a good stock, it's not going to zero, most likely. So a higher risk may mean significantly higher probability of winning. Now, here's an example of risk to reward ratios. You can see a 1-to-1, you can see a 1-to-2, and a 1-to-3. I personally target a 1-to-2, but I'm hoping to improve that over time. And here you can see a chart of win rates and risk to reward ratios. You could pause it if you want to check that out. But the third thing we're going to talk about is stop loss. This is extremely important. A lot of people think, oh, well, if I put my money into a stock and it's a good stock, they think it's just gonna go up. So there's no point in putting a stop loss because if it goes down, I'll just wait for it to go back up, right? Well, it's not true. Because if you're willing to risk 50 and the stock drops below that, you could lose more than you want to risk. So you should set a stop loss or limit order, same thing, to mitigate your risk. For example, if you purchase a stock at $100 and you only want to risk 10, then where are you going to set the stop loss? Once the stock hits $90, you're going to sell the stock at a $10 loss. If you don't set a stop loss, that stock could go down to 60 and now you lost $40 compared to the 10 that you wanted to lose. Not that you want to lose, but that you were willing to lose. It's extremely, extremely important when you're investing or trading to limit your losses. I can't stress that enough. It's extremely important to manage your losses. If you can manage your losses, you, for most part, be okay. It's called risk management. It's, like I said, it's one of, if not the most important thing when you're investing. It's very important to manage your risk and limit your loss. Now, here you can see an example. You can see if we buy here, stock goes up, when it starts dropping, if you set a stop loss order, it will automatically sell the stock here, right? Which is below where you bought it for. However, you only lost this much red, compared to if the stock dropped all the way down, you will lose all of this. But you didn't because you set a stop loss order, which is, you can see how it can mitigate risk. Now you might say, well, the stock might go all the way back up again. Okay, but you didn't want to lose this much money, right? What happens if you need it? So it's very important to set a stop loss order. Now, similarly to a stop loss order, we have a take profit order. What's that? Well, it's just the exact opposite of a stop loss. You set a take profit or limit order at the amount of money that you want to make, that you want to profit. So, for example, if you buy a stock at $100 and you want to make $50, where are you going to set the take profit order? Exactly, $150. Why? Because once the stock gets to $150, your take profit order or limit order is automatically going to sell the stock at a $50 profit. Why is this important? Because the whole goal is to make money, right? everyone wants to make money in this. Well, you can't make money if you don't sell the stock. So it's very important to secure the money you do want to make. Well, if you're going for long term, you don't have to set take profit, but just monitor your investments. But if you're targeting $50 and your goal is to make $50, if you want to secure that $50, set a take profit or a limit order at the whatever price is going to secure you that money. And it's important to secure profits because over time, profits add up. And what's the last thing? The last thing that is also one of the core foundations of investing and trading is you have to take your emotions out of money. If you let your decisions be fueled by your emotions, I can almost assure you you're probably going to lose money. Why is this? Because over time, humans, we have a very strong emotion toward money, right? If you see $100 on the ground, you're going to say, wow, I'm taking that 5 seconds, right? If you lose $20, you're going to say, damn, I just lost 20 bucks. But when you invest, you're actively recognizing that you're willing to risk your money in order to possibly make more. So it's extremely important to reduce your emotion toward money, or else you'll be investing in trading emotionally, which is not a good thing. Why is it not a good thing? Because let's say you lose $50, right? You're gonna say, "Damn, I lost $50. I didn't want to lose that." You're gonna say, I'll make it back. I'll make it back in 5 seconds." So then you're gonna risk $100 to make 20 back. So you lost even more than $50 because you emotionally wanted to get the 50 back. So you risked even more money, and you only made 20 back. So let's see. You lose 50, so that's minus 50. Then you risk 100. That's minus 100. Then you make 20. So we have 150 minus 20. You lost $130. When you could have just lost the 50 if you just stopped right there. But you didn't because you were emotionally investing in trading. So you lost even more money. Now you can see how that's a humongous problem. And you say, well, who would do that? Well, it's just like gambling. Honestly, I'm not gonna lie. It's people lose the money and then they say, I can't lose this money. So they put more money in, thinking they're gonna win, they're gonna win, they're gonna win, and what happens? They just lose even more. So if you reduce your emotion toward money, and you know that it's just money, it can always be made back. Like if you lose $50, you say, okay, that $50 will come back. It's just money, guys. Yes, I know money is very important, but if you're going to invest, you must take your emotions out of money. So you're not trading emotionally, you're trading smart. You're managing your risk, you're managing your profits, you're managing your positions, you're not risking too much, and you're not trading with emotion. And if you do this, overall, your time investing will be much, much smoother, much less stressful. It's overall better to dissociate yourself from your emotions and money. But yeah, guys, that's it. That's essentially the 5, in my opinion, most important things about investing. So I hope you guys took something from this video. And these are personally the 5 top rules that I follow when I'm investing. So I hope this video was informational. And now that's the end of our investing part of Wise Wealth. Now we're going to go into the macroeconomics, such as the interest rates, the Federal Reserve, how banks move money, all that. That stuff I'm very interested in. So hopefully those videos be some more fun. But yeah, thank you guys for watching.